Hello, my name is Dimitri Courtelis. I'm the Group CFO here at SunRice, and I'd like to take you through a snapshot of our FY25 annual results that we released to the market a couple of weeks ago. In terms of our group structure, we have an A and a B class shareholding structure. The B class are listed on the ASX, and the A class are represented by our growers, which is a non-listed share. So the company is essentially owned by our B class investors, which have 100% rights to dividends and certain voting rights as well. More details on this can be found on our website. In terms of a brief thumbnail sketch of the SunRice story, we are 75 years old this year, going back to our roots as a cooperative back in 1950, and progressively have launched and created brands, acquired milling operations, acquired ancillary and supporting business units over the years to the group that we are today, which is a over $1.8 billion top line revenue business. And in the year, we just delivered 147 million of EBITDA, which I'll talk to shortly. From a geographical perspective, as you can see here, we really do have markets across the world. We operate and sell products into a multitude of countries. We have over 50 countries that our products are located in and listed in various retails and wholesale stores. Over 60% of our revenue is generated outside of Australia. And of the total group revenue, 70% is in branded sales. So the step change shift in terms of how the group has evolved over the last few decades is essentially moving away from a pure agri-focused bulk trader of rice into a global FMCG player, branded player that has branded products in all of the markets that we operate in. We have over 1,500 products across our product suite, and that comprises over 45 major brands and with operations in over 10 countries around the world. In terms of the update of our annual results for FY25, we had flat revenue coming in at $1.85 billion, and I'll talk to the drivers of that. But pleasingly, our EBITDA up 3% to 147.7 million, and that flowing through to NPAT, where we delivered a $70.7 million number. That equated to a basic EPS of 102.9 cents, which was up 6% on the prior year, and our largest ever dividend declared for the year of 65 cents, which comprised a 15-cent dividend that we declared at our half year, which we went to the market in December, and another 50 cents in our full year in June, taking the total dividend for the year to 65 cents. So a very healthy dividend yield on that number. And you'll see shortly we have progressively and continually paid consistently and strong dividends to our shareholders over the years. In terms of the activity for FY25, on the positives, we had some significant brand strength coming through, which bolstered our sales. We did grow volume in a number of our key markets, the Middle East being one of them, also supported by new product launches, and we had a very successful Ramadan campaign earlier this calendar year. In the US, with increased exports rather, due to ample supply in the Northern Hemisphere, we have a milling operation in California, and that helped to support that supply chain. And then in Australia and the rest of our international markets, some strong performance in some of our key brands. Toscano was one of the core brands, which is essentially the artisanal pizza baking and bakery brand that we have with one of the most popular pizza bases in the country. The top line revenue was put under a little bit of pressure from a perspective of just weaker global tender prices that kept prices below long-term averages. And then, of course, the impact of cost of living pressures coming through in consumer spending. Despite that, we were able to deliver an EBITDA increase of 3% on the prior period. And as mentioned on the previous slide, delivering an NPAT increase in the 70.7 million mark. Sustainability. So it really is in the pillars of what we do here at SunRice, cut across four key components of thriving people, thriving planet, thriving community, and inspiring products. We've had some significant step changes in the space. The rice growers in Australia are amongst the most efficient rice growers on the planet. due to necessity from a water availability perspective, and we're actually utilizing that type of technology in the other growing regions that we grow rice. So there have been some significant step changes here in water usage in particular that has also helped shape our sustainability footprint and our sustainability strategy. We've also launched our net zero roadmap for 2030 and 2050, in addition to the science-based target initiatives that we submitted last year and are tracking against that on an annual basis. A quick segment snapshot in terms of the various divisions in SunRice. So the Australian rice pool business was put under a little bit of pressure from a poor milling yield. This is the amount that gets paid to the Australian growers, and we came in at $406 per tonne, which was down on the prior year. That doesn't materially impact the profit businesses, which you see on the right side of the group, of the page. All the businesses that are reflected here on the right are, as I mentioned, owned by the B-class investor, and the company essentially delivers that profit with the entitlement to dividends entirely for the B-class investor. So going through the profit businesses, our international segment, which is our largest division, delivered a revenue of 860.4 million, slightly down on prior period for reasons that I mentioned previously, with global tender pricing being one of the main drivers in that space. Despite that, though, we were able to deliver a very solid EBITDA of 56.7 million, which was in line with last year. And the rice food segment, which is a lot of innovation has gone into this space. We have a very broad pipeline of products, from rice chips to rice cakes to protein and other types of rice snacking, innovative products in that product suite. Quite healthy from an accretive perspective in our EBITDA margin, and our EBITDA number coming in at 18.6 million, which was substantially up on the prior period. And you can see that revenue growth to 132.5 million as well. Riviana Foods, the next segment, is essentially our artisanal product offering of entertainment platters. And we have products like olives from Greece. We have pesto from other parts of, or we actually manufacture that locally in Australia. We have pizza bases that we import out of Italy, croissants that we import out of France and Belgium. So your European-style artisanal product suite, about 80% of the products in Riviana Foods are imported. So the segment has been exposed to the FX volatility as well as the supply chain disruption and shipping costs that we hope to start stabilizing at the moment going into the next 12 to 18 months. FX continues to remain the significant pain point because we purchase most of those products in US dollars as well as the euro. And as the Aussie has depreciated, it's put a little bit of pressure in that segment. Moving on to Courtelis, which is our animal nutrition division. We've had a very solid year in Courtelis, with whilst revenue remaining pretty much flat compared to last year. The product mix and the accretive product suite that we brought into the animal nutrition segment with the recent acquisition of SavourLife and a few years ago with Pride's Easy Feeds in the equine space, we have delivered a material contribution to EBITDA. Courtelis's EBITDA, 24 million, that's up 40% on the prior period, and really helping to step change that segment away from historically, which was a stock feed and ruminant type of animal feed business, into now more of a branded FMCG animal nutrition space. And then finally, the corporate segment, which owns all of the assets of the group and essentially charges a asset finance charge to the Australian rice pool. So you can almost treat that like an annuity style income. EBITDA coming in at 40.5 million. That was down on last year because we had asset sales last year that were non-repeating. So underlying numbers still coming through very solidly from a corporate segment perspective. Just a brief history of performance. You can see our revenue has grown over the last number of years, and despite what's happening in the Australian rice crop, we've demonstrated that we're able to build a resilient model of sourcing globally and creating a demand and supply profile of matching the types of rice that we need to supply into our international sources, and continue to do that year in, year out. So regardless of what seasonality or drought is doing in Australia, over the years, we've built this resilient supply chain that we're able to meet the global demand of our markets. That has fled and filtered through into our EBITDA and NPAT numbers. So you can see that with the performance in the bottom left-hand chart. Top right, we have a consistent and strong dividend profile, and it has been the case for many years, both when we were listed on the NSX and more recently on the ASX. This is now our 6th year on the ASX, and we've continued to deliver strong performance for our shareholders, and most recently a 65% per share for the total year. And EPS again coming in at 102 cents. So we have outperformed the index when you compare this over the preceding years, 350% against the ASX 300 accumulation index of 110%. We have paid out $252 million worth of dividends to our B-class shareholders over the period in the charts. And we've also invested almost $400 million in growth. And that's a combination of M&A, which is around $135 million over the last 7 or 8 years, in addition to CapEx, both strategic and operational in nature, with our own internal hurdles to ensure that we are creating value and delivering against a WACC rate so that we're creating value for our shareholders. From an EBITDA and a cash flow perspective, you can see the profile growth compared to prior period, and rice food and CopRice really has been the standout segments to talk to, and that's where a lot of our innovation, product growth, and from a margin mix perspective, where we're looking to deliver more products going forward. So watch this space. We have an exciting pipeline of innovation that we're looking to launch to markets. Net debt consistent with prior period, coming in at $218 million. And again, ROCE 13.6% as we continue to create value for our shareholders. The gearing ratios and leverage, so gearing coming in at 26% and leverage at 1.5 times. That is entirely made up of seasonal debt. We don't have core debt. We've paid all of that down, and that's evident on this page. So our seasonal facilities are essentially back-to-back with inventory, which is our short-term, essentially marketable asset in markets over the coming 12-month period. So we've been able to go after some acquisitions that we essentially funded from our in-year operating cash flow and continue to have a very strong balance sheet and prime for future growth. We have just under $200 million of capacity in our core debt facilities that we're able to go after acquisitions should they fit into our strategic pillars. Just a quick recap on our strategy that we launched to market in December earlier to 2024. So the core focus in our 3 key markets, which is across ANZ, it's the Middle East markets, and it's the US markets. When you consider rice, it is the most calorific carbohydrate on the planet, and it's consumed by over a third of the world's population. So really launching products into this set with a staple product, staple diet, and add and couple that with innovation, particularly from a rice food perspective when we talk about products like value add, particularly in the microwave segment, rice chips, rice cakes, and protein as well. We see some opportunities in the core markets that I've mentioned, where we're looking to launch these products and then also increase the breadth and the depth of our offerings in the markets that we are currently operating in. And progress against strategy. This is essentially year 1 of our 2030 strategy that we kicked off earlier this year. So over the next 6 years, looking to really deliver growth at the top line and the bottom line, where we have an aspirational target of growing the business to $3 billion at the sales level and get to double-digit EBITDA percentages. And how we would do that would be a combination of both organic growth and inorganic growth. And over the period, obviously, assess to make sure that is accretive in nature and contributing to the overall growth of the business. So a number of product lines that we've launched in a number of categories, strong progress in our sustainability strategy. We have developed a growing engagement and industry transition as we've given up the single desk. So we're no longer the single export license holder in Australia. And therefore, we're able to work a lot closer with our growers locally to essentially have more bilateral arrangements and contracts in place so we can strategize and get them to grow the volume of rice that we actually need to address our utilization and efficiencies in the mill, so we can return a healthy paddy price, but then equally deliver into our international markets. And continuing through the piece with operational efficiencies and cost optimization, and again, a capital management strategy where we have a strong balance sheet and continue to look at opportunities as they see fit. From an outlook perspective, a number of items on the page to call out, but really the summary of we're looking to continue the momentum that we delivered in FY25 and take that into FY26 with growth at both the top line and the bottom line. We do have a number of headwinds that may impact that, the likes of intensified competition. We've got some currency challenges with the AUD and particularly against the US and the Euro, in addition to the Papua New Guinea kina, which is a very big market for us, and we sell a lot of rice into that market. And then, of course, the noise with global tariffs and trade impacts that may eventuate. But aside from all of that, we certainly expect to deliver another strong year, and we're working very hard to do so. Ahead of us, from a paddy price perspective, the C25 crop has been harvested, and that has resulted in a total received of 511,000 tonnes of paddy, raw paddy. So that will be more than sufficient to essentially deliver a operational footprint for the coming 12-month cycle, and therefore make sure we have a full milling program accordingly. We've held the paddy range for the Australian growers constant at $380 to $450 per tonne, and we'll update that as the year progresses. So thank you for the presentation today. Looking forward to questions and following opportunities to present to you again.